Hey there, Rodney Miller, Hard Money Partner. Today, I'm sitting here with Ed Zinnamon. Hey, Ed, how you doing?
I'm doing great, Rodney. Great to see you, sir. Good to
Good
see you.
deal, man. It's good talking to you, and I think we're gonna have a great conversation today. I've known Ed for many years now. We've had breakfast several times, and we talk about the markets, talk about what's going on out there in the real estate industry. And Ed turned me on to multifamily years ago. He had a multifamily class. We'll talk about that a little bit, where Ed teaches multifamily to a lot of single family guys or people that want to transition. And we'll get into that a little bit. But we'll talk a little bit about kind of Ed and his background. Ed is one of the operating partners or the operating partner at MP RIA, one of the larger RIA groups here in Oklahoma City, with lots of members, kind of the go-to place if you want to learn how to do real estate investing or you want to network with other real estate investors. Ed is instrumental in that program. Ed's also a broker with First Commercial Real Estate in Oklahoma City. Ed specializes in commercial investments. You're not much of just a retail real estate guy, right? You more
I did
investment.
a few retail houses, and most of those are either for friends or somebody I investor flipping.
Sure, but your specialty is commercial and
Investment.
investment property. Um, uh, and he also has Ed Zinnamon Real Estate Services, where he offers coaching. He does his classes for multifamily. Really good stuff from a guy that really knows his stuff. Has been in the market for a long time. So I'm gonna read off some of your bio here.
Okay.
Excuse me for reading, but it's pretty extensive. But um, uh, you've been a real Ed's been a real estate broker since 1989, specializing in investment properties. Ed grew up in the real estate business with his family, building and managing several multifamily properties. He's the host broker for 7 years for real estate tours in conjunction with a national company out of Utah. And during that time, conducted over 30 week-long tours with over 500 investors, and that's interesting. I remember you telling me about that. Um, has successfully completed transactions with over 300 investors, with many repeat clients that he's worked with over 22 years. And he enjoys using his 30 years of experience in being a part of investor success and reaching their real estate investment goals. He does so by teaching, public speaking, writing, coaching, and assisting with clients' purchases and listings. So, pretty impressive, Ed. Pretty impressive.
Thank
Welcome
you.
to the show.
Thank you. It's a pleasure to be here, sir. Thank you.
So, I want to
I
get
know
you
we've
on
been
here
talking about
because,
this for a long time, so
yeah, exactly. I want to talk to you because we've talked extensively about multifamily, and you kind of turned me on to it early on, and your classes are really good. They really sparked my interest, and really kind of opened my mind to multifamily and how achievable and attainable it is for a small single family guy like me. And really got me on the journey to multifamily. But that was really the spark. Was your class? You had a Saturday class. I think it was a half day or something where you kind of went through the A's and B's, nuts and bolts of multifamily, and learned a lot. But I guess we just tell me a little bit more about yourself and your history, and your, kind of, were you raised in real estate? How did you get involved in real estate?
well, I joke about it. I was actually born into this business. We lived in Long Beach, California, and I was born out there. And when my parents brought me home from the hospital, they brought me home to a fourplex that our family owned. So I literally was born into the business. And so my in grade school, my first jobs were cleaning pools, vacuuming yards at apartments, emptying out trash apartments. Back then, we had furnished apartments, and I hated that because the minute we would furnish one, the next tenant wanted them unfurnished. We'd move that to storage, and the next people wanted the furniture back in, and so we got away from that. But painting and cleaning, and I got to learn first. I was young. I am very serious about real estate, but I like to joke too. So this is a serious, I mean, a realistic joke. But I used to know when I was in grade school, if we got a call in the middle of the night, it's something about the apartments, and we're going over for a fire or a tenant or something, it's a little 21 unit. I'm like, I'm missing school tomorrow. I don't have to go to school because I'm up all night. So, but I've been around, when the police were doing stuff, so I've been sort of around that. And my mom, she's been in it. She's like in her 80s, and she's been doing this all my life, and I think right now she's got about 500 units that she oversees. At one time, she had a little over 1,000 units as far as the
Oh my
management stuff.
gosh.
Yeah,
80
she
years,
loves it. All
80, and she's got 500 units she oversees.
Yeah, and all of the properties call into her at night. All the phones are forwarded to her personal phone for take the phone calls at night.
Wow.
And as something happens, her eyes light up. She's got maintenance guys. She can get on the phone and make everything happen. So, but anyway, but I've been around that. But I did the tours. I grew up in like I said, in the multifamily business, and uh, I love figuring out how to make the deals work. Okay, and I can go into a little bit about the tours, but I've been doing this again a long time. I don't know everything, but every day I still learn something, and I'm always working on my systems and things, how to make things better from inspections or notices or dealing with tenants or stuff. But I just have a passion for multifamily and to get it done. I love to help people make money. If I can. One time, one of my oldest, they were the first people. They tested me out, and I got into real estate. And actually, how I got into multifamily into real estate real quick is a brokerage. I went to work to sell houses, and this company specialized in houses. And the broker got a listing on an apartment house. He goes, "You're the only one who knows anything about apartment houses." I'm like, "Oh, okay." Well, I sold it in Fort Smith, and I became known as the apartment guy in Fort Smith. But it didn't take much. Okay, so but that's how I sort of got into that and moved over here. I quickly learned I wanted to specialize into that. Now, you did mention retail. I did work for a company in Fort Smith. We developed 1,600 lot country club subdivision overlooking the city, which was nice, and free membership to the club. That was nice. So
That's cool.
I love multifamily. So
Okay.
that's
Well, tell us about those tours. Tell us kind of what the tour
well,
is all about and when they happened and kind of what you guys were doing.
Well, when I moved here, a company I won't go into names was offered when I first moved here. Another office offered the company I was going to work for, saying, "Do you want to be the host broker?" And that broker didn't
And
want
what
me.
what year was this? Let's date you.
1997
Okay.
started conversations. Summer '97. And it just was slow play. And I didn't realize later that the two owners of those two companies was not really working out. So I decided a year later I closed a deal with Home Depot, which was a pretty good paycheck. And I'm like, I'm gonna start my own company. And when I did, the other company called me and said, "Now that you're on your own, we want you to be the host broker." And I said, "Okay." And a funny story, I just moved here from Arkansas, Fort Smith. I did not know my way around town. So I'm doing these bus tours. I'll go more into it. I'm having to get a map out. I don't even know where I'm going. But I quickly learned the town really, really fast. Okay. But anyway, so I was a host broker in this company out of Salt Lake City. Their average at that time, by the way, is to do 3 to 4 tours. And a tour was 5 days. Now we changed them; they were Wednesday through Sunday. We moved them to Monday through Friday, but 5 days. And they had never been here before. And these people didn't really know each other. They'd been to an out market. It could have been in L.A. or New York or Houston or Seattle, and we had a couple in Canada that they bought. Say, "Oh, we like Oklahoma City," and they came here. Now back then, our local market, everybody thought we were crazy. They were like, "You're paying how much for multifamily? That neighborhood is scary," all that kind of stuff.
And these tours were exclusively for multifamily for investors looking to purchase multifamily. Okay.
Correct, correct. And they had to qualify. They had to have so much money, and but some of them were buying duplexes. But back then, they were selling a rent house in California and buying a fourplex here for the same amount of money.
Sure.
But we would have 2 to 4, what I would say, higher rollers. They were like $1 million to $5 million. You got to think back in the late '90s, early 2000s. That was buy you quite a private property. But we were selling fourplexes back then for 60,000. Okay, so but anyway, they would come in. We'd have them for a week, and we'd get them to work as companions instead of competitors. Which, if you want me to, I could touch on that really quick. I know
Go
this is
ahead.
sort of off topic. Well, if you go into a neighborhood, it's a little bit. Um, well, I know we're going to talk on the difference of single family and multifamily. Can I share one right now?
Sure.
This plan works great for single family, and excuse me, single family or smaller multifamily like quads. Okay, larger complexes, it's a little different. Okay, but what we did back then is if you could go Paseo area, or you could go in these areas that the whole street's not looking good, low income, is if I convinced these and I had people just on my team just calling owners. That's all they did. And we would say, okay, if four of you in here would buy these six fourplexes, and you guys all have the same plan, and you get the same management company, you could change the street. We really, in the late 90s, early 2000s, changed Paseo area.
Wow.
We were the ones that did it. Some of those properties I've sold 4, 6 times. Actually, I'm still selling two right now. It's this many years later, and it's amazing the prices. Okay.
Wow. So you get a bunch of guys that come in on a tour and they agree to buy up these streets and they're just going to turn these whole neighborhoods around, bring the
Right.
values. Wow. Okay.
Now, what happens is we tried like East Drive and a few other ones where we tried that, but you're only as weak as you're only as strong as your weakest link.
Mhm.
So if you've got some neighbors that are not going to change and still live the lower income or like drug people or whatever, it's going to be hard to get those that are tenants in there. So that works on smaller single family, but real quick on multifamily, and I don't want to ever say anything that would be against anything you teach. Okay, I'm just going from my experience.
I
Okay.
don't teach anything. You go right
Okay.
ahead.
Or when you're talking with clients or person people want to get involved with you, I
Sure.
have found overall if you can get a multifamily that's more by itself versus lined up with four other multifamily properties all on one street, you have a better chance of controlling your type of tenant. When you have there's streets in town, I don't want to name that, there's streets in Lawton that you're only again as strong as that weakest property complex.
Sure.
Okay, so you go and spend a lot of money, but if two doors down, they're letting the maintenance go down, and they're letting all kind. They're not doing very much weeding out of your tenants. Okay, is screening, and next thing you know, you got a lot of problems. You got shootings down there, or whatever, broken cars. It's going to affect you really making the value add on your multifamily. So I
Absolutely.
think and so, and
And
you can sort of like
speaking of that, when we're looking for properties, we're looking for, it's just like houses. We don't want to be the innovators on a street or a neighborhood. We don't want to be, we don't want to be the proof of concept guys. We want to be the guys that pick the property, and we've got the people around us that have already started that process, have already infused capital in these things, have already proven that if you put a carport up for these people, they'll pay for it. That if you put a little backyard, if you add a backyard behind the back door with a little fence area, that people pay an extra $50. That if you upgrade the units to all the new amenities, that people will pay an extra $75. We don't want to be the guy that goes in there and does that first off the bat, and then we leave it to them to catch up with us. So that's a scary, risky proposition. That's exactly what you're talking about. You know.
Can I give a little promo to you on that then? Because I get calls, because I am a listing broker. I've been doing this for 35 years. And by the way, I say this, God's been good to me, but I've closed over about $375 million in transactions. So, and it's really, God's been good to me. And that's from fourplexes, houses, single family to, 200-300 units. But what I want to say on you saying that, I get a lot of calls on my listing. And I can sort of tell if they've been to some classes on how to syndicate properties, okay? And people think I'm against syndication. I'm not. I'm against people who don't know what they're doing, okay? Because they're going to hang their clients out to dry and cost them a lot of money. That's why I'm doing this with you. I respect you. You know what you're doing. You know how to make the deals right for your potential
Sure.
investors.
Let's explain to people
Okay?
what syndication is, because a lot of people probably don't know what syndication is.
You go ahead. You the
Syndication
guy.
is where you're how can I explain this? Because I'm not an expert at it, but I mean, it's opposed to me buying a property off of Ed Zinnamon, and I'm going to put all my cash up and buy this property and put, it's $4 million. I'm going to put up $1 million of my own capital, and it's my property. I go out and find investors, and I get those investors to all invest as passive investors in my deal. They're putting up most of the equity to purchase the deal. We get bank loans, but we're going to use them to bring the 20% equity needed, the capex budget to fix the property up. That's all going to come from private investors, and that is a syndication. We're taking a bunch of people's money, putting it in the deal. We all share in the profits. I'm the general manager. I'm running the show. These guys are passive investors. We're syndicating the deal. And that's basically how I explain syndication.
Yeah, the passive is and I've signed some investors that are doing both. Okay, they like to do some, their own, but they get bigger deals. they can maybe go buy a house or a quad on their own, but they can't buy a $5 million apartment complex. It
Sure.
takes more to put the deal together. But that the really key word is passive. If I may just, I do rabbit trails. We do a little rabbit trail. What
Cool.
you just said, as far as having your partners lined up, that's one of the key things I do. I get frustrated with investors, or excuse me, new syndicators. They call me, and I could tell right away they're wanting value add, which all that stuff is good. But I could be like, they're not asking the right questions, or they haven't done their homework. So I ask them these questions: do you have any partners lined up? And if they say no, I'm trying to get a property under contract so I can do a mail out and see if anybody's interested. I said, so you've not talked to anybody. I'm not saying I won't help them, but versus talking to you, which you have a relationship with other investors, they're not all ready for your deal now, but you know they go to, they trust you. You can put a deal together, okay?
Sure.
Versus somebody that's like, okay, I went to a class, I want to go do this, and I had one guy say, I want to own. I remember it's been a few years ago in August. They said I want to own 500 units by the end of the year. And I'm like, you have one rent house, okay? so,
Slow down.
so yeah, and so like let's take a little bit of bite at this at one time. Anyway, so we did these tours and we helped people and uh, and so we did a lot of business. And by the way, if you don't, I go a little bit into that. They would come here. It's very interesting. We did a networking night, and then we did a training day. We talked about the metro. We talked about the different areas, the crime rates, the different types of profile of your tenants, and then we put them out for a whole bus. And this one reason I stopped the tours is I had to have 50 properties to show them in the market that either made sense or was close to it. Right now, if there was 10 to 15 that made sense today, they wouldn't be here a week from now. Okay. And I had to know
Yeah.
that like 3 weeks out.
Yeah.
And so we'd show them the bus all day, 53 passenger bus. And until I changed it, one weekend we wrote 128 offers in one weekend.
Ooh, wow.
Some of them had 10 to 15 offers on one property. And I remember I went to one seller, he goes, which one to take? And I said, oh, they're all about the same. And one of my buyers got creative and he said, and his offer, he said, choose my deal and I'll bring beer and pizza to the closing. So,
Oh, beer and pizza.
to the closing. Really, we changed it, but so that was my tours. And when the market, I think it was in 1996, really sort of changed, with different things in the business and everything, real estate going down and apartments. And fortunately, let me just mention this: our apartment market never really hit bottom. It just stopped growing and sort of going a little down. We never hit like other parts of the country. And so that's when I got into doing single family, and with a friend of ours and working with the RIA. And I remember when I was doing video because I have a video company too, of the weekend of the a week Saturday training, and I'm like, I don't understand any of these terms he's talking about because I'm a multifamily guy, and if I can, that's one thing I might mention on. One of the differences is terms. Okay, when you go single family, back then I remember talking about ROI. I'm like, what in the heck is an ROI? Because I'm like cap rates, cash on cash, debt
Hmm.
coverage ratio, you know, NOI. I'm used to all that stuff. And like, okay, and then he's doing percentage of rents per month. I'm like, what?
Well, I'll tell you though,
How?
ROI matters when you're doing syndications because that's what they want to know. These
Well,
people
ROI and
just
all
want to
that,
know their ROI.
all of that matters on apartments. I'm
Sure.
saying was dealing with single family.
Oh, I got you. I got you. I got you.
Okay,
Okay.
so I'm used to dealing with all this on multifamily. ROI, all of that matters, and it's based on annual numbers. That's a really big thing. You've been in my class that I teach. It's all on annual. And so I'm here in this class on single family, which is not wrong. It's just different. Is it's all percentage of rent for the month, how much do you get at least positive cash flow. And I'm like, you're not putting some of the expenses I would put in, and they're not looking. They're looking at long term. Get it paid off in 15 years, and I had to sort of adjust my thinking to that. Okay,
Sure.
but I had to get what's the ROI, which is real estate owned, and so and it's by the not ROI. Excuse me, I said ROI, REO. That's what I
Okay.
meant while ago. Sorry about that. Real estate owned. You're right. ROI. Sorry, wrong thing. That's one thing you got to get used to. There's a lot of abbreviations, especially in the
Sure.
commercial business. But REO, sorry, real estate owned. That was a foreclosure property. Okay, and so I started dealing with that. And REO, excuse me, I knew what ROI was. REO, I didn't, and so I had to learn that. And so now I teach on that because I've done a lot of deals on that. At one time, one of my business partners and investors I was working with, we were doing 4 to 6 houses a month. He was buying, sometimes more. And but anyway, so I had to sort of learn that business. But I did mention a lot of the single family, a little bit. If I could talk about the difference, and don't let me just take over, Rodney. But if I could talk about the strategies, a lot of now we're talking about not the flippers because you can't flip single family and apartments. Not as much, not as easy on multifamily. But the strategies on most single family investors that are not flipping is to buy, hold it, get it paid off, and that's their retirement. They want to put on a 15-year note, okay, 12,
Sure.
15. Shorter the term, lower the cash rate. Longer the term, higher the cash rate. But on most multifamily, even if they're buy and hold, but if you watch most of the buy apartments multifamily, they don't hold them for 15, 30 years. They hold them 3, 5, depending if they have a negative issue, but 3, 5 years. And that's why you'll see them put them on a 20 and 30-year amp and put a 3 to 5 year balloon. Because like what you're doing, you want to do the value add and either sell it or refinance it. Okay. So that's one of the things you're looking for. And your investors are looking for a different
Yeah.
uh,
We
return versus buy and hold house.
when we analyze these deals, it's really specific how you analyze a multifamily, and you taught me some of this. But when we analyze these deals, especially for syndication, we need to do we need to have an end game, and so we usually have a 5 year projection. Here's what we're going to do. We're going to buy it at this, and we've got this amount of money allocated for capex repairs. We think we can get the rents up here. The net operating income is going to get up here over a certain amount of time. It's going to raise the value based on the cap rate that we think will be relevant when we go to sell it, which that's kind of some guesswork there. And here's the pot of money we think we're going to have, and then we're all going to divvy it up. And your return based off of this will be this. But we have to do it on a 5 year projection, and that's kind of what we look at when we buy a property. It's a 3 to 5 year plan. We're either going to bring the NOI up and refinance it and pull a bunch of money out and pay back the investors and ourselves, or we're going to sell it to another operator. But we put a bunch of money into CapEx projects. Well, every day that sits there, that stuff's deteriorating. And so if we held it for long term, we'd have to go through that process again. So it makes sense to turn these things. Buy and hold's cool. And there's something to be said for buy and hold, but a lot of guys now, the value add stuff, they put the money in up front, then they turn it to another operator, or they refinance and pull the money back out and hold on to it. But you taught me that. Thank you.
Well, this is not just, one of the reasons, again, I'm on here because I trust what you're doing in syndication and stuff. And I don't do that with a lot of others. Okay. And the reason is you just mentioned, you look at the rent, you look at the CapEx. I've worked with you on some deals I wasn't part of, but we just talked about. Mm-hmm. And you're very thorough in making sure what you promise. I mean, you can't promise 100%, but what you do is you weed the averages, your percentages by doing your homework. Okay?
Sure.
And you do your homework. And just like you and I've talked, and not being negative in Oklahoma City, there's still deals here. But it's harder to find great value add deals. Okay, that's why we've looked. I'm not saying they're not. They're just because people are upping what they'll take.
Sure.
Okay. But it's really, when I get these calls and I know right away they're a value add, I'm like, you are not going to buy that property, increase the rent's $100 this month. This year, a unit.
Sure.
But that's why when you do a deal, you've done your homework. And so you're like, we can't guarantee it, but we do have research to back up what we think.
Well, when you're syndicating, you almost have to, because if you're raising capital from other people and you're projecting a certain return for these guys, if you don't deliver it, you've just wasted your time. You're never getting another dime out of these people. And our goal is under promise, over deliver. And then these guys run and tell their relatives, their friends. And next time we do a raise, the first raise we did was 1.2 million. The second raise was 2.5 million. So we kept them happy the first round. Then they came back and gave us more money, plus some people they told about it. And it just keeps escalating to where maybe someday you get to do a $20-30 million deal. As long as you deliver what you promise. Now, when you stop delivering what you promise, when you start slanting the numbers in your favor to get their capital in the deal, That's where it goes all south. Because if you don't deliver, man, these people are not going to trust you and they're not going to stick around. And that's the big part of syndication.
I mentioned something about flipping, and I consider this is my opinion. A lot of stuff you get in this, some people are going to have opinions. On flipping an apartment, I don't consider, I consider flipping more the first one you talked about where they throw all the money into it and get out of it. Okay. That's what I call flip. I think you're more of a syndication. We have a long term plan. We're going to get a bigger return. But there's people buying apartments, they have no goal to keep it. They want to get it fixed up and sell it immediately. Okay.
Sure.
And there's some making money on that. It is a little bit harder to, you can do it, but it takes a lot more money. I will say on selling, and we don't have time to go into all this, but when you do single families, you don't run into much capital improvements, capital gains tax. But when you do your apartments, you do run a little more into that. There's timelines you need to stay within, and we won't go into that, but a little more constraints on that. But also flipping, by the way, let me just jump onto this really quick. If you look at how properties values are determined, okay, if you look at single family, it's looked by sold comp. What is that house per square foot? What is that house per square? Even if you're doing a rental, many times it's per square foot or this is the 3 bedrooms. But if you do a multifamily, it goes on a lot of these terms. It's market driven. So if you raise the rents, $20 a month, $50 a month on 20 units, a lot of banks are going to want you to have at least 90 days to 1 year, depending on your lender, of a track record that you not just got 1 out of 20 at that rent. You really been able to get it and keep it. Well, then you don't have to wait. You can double your value if you can increase your rents and you get a better condition, lower cap rate. It's a little bit harder if to buy a house and double your rate unless you buy it really cheap.
Sure.
Okay, there's not a lot you can do to increase that value besides buying it cheap.
Yeah, and that's a big deal. That's a big difference, like you said, between single family and multifamily. One of the big differences, single family is based off comps. I bought this house. It's 30,000 below comps. I'm going to try to flip it and sell it for the comps. I'm going to make 30 grand or whatever based on what the houses around are selling for. Commercial property and multifamily is based off of net operating income and a multiple of that, which is the cap rate. So the goal with that is not just to bring it up to the comps are based on how much money the thing's making. So it's really not what's going on around it, but how much will this piece of property generate? And if you can raise that net operating income, and you can get the same, good low cap rate, or you keep this cap rate relatively, if you know the cap rate when you exit, you kind of know if you can get the net operating income up, what you're going to make on it. But that's the two main differences between single family and multifamily. And it's great you brought that up. And, when you're talking to people and they're calling you, and maybe they're a single family guy and they're going to be a new multifamily investor, you got a big bullshit factor, detector going on. The keywords, the few things they say that, this guy's not a player. He doesn't know what he's doing. What are some things that tip you off that because I've had people call me about wanting to borrow my hard money to do a real estate deal for a multifamily 25, 30 unit. And I can tell right off the bat, I can ask them 2 or 3 questions and they have no idea what they're doing. What kind of tips you off that somebody kind of hasn't really studied multifamily and they're not worth your time? I mean, it sounds mean and everything, but your time is valuable. And you're not going to spend a lot of time taking somebody around to look at multifamily deals if they really don't know what they're getting into and how to take one of those down.
Well, I get a few people that are single family trying to get into multifamily and have not done any research. Okay. And I'll come back to that, but I get a lot of people that's trying to transition and they've had some really, this is how you do it. And I can tell by the questions they ask, they've not done a multifamily deal. They've gone through a training, which, a lot of stuff, when you get your real estate license or whatever, you're trained how to do that. Then you go out and really learn how to do it. You learn the basics and now how to go out and do it. But what I get from people that are doing single families, first of all, they'll ask me about monthly numbers. I can tell right away. And they'll ask me what percentage of rents. They start asking me the single family questions. Okay. Sure. And one of the things I'll do is I'll talk. One of the first key questions I ask, not someone syndicating, but someone looking to buy, is have you talked to a lender? Because many times I can tell by who their lender is what kind of stuff they've done. And here's the other key question. Now, except for syndicating, and I hate saying this because the last 4 deals I put under contract have not fit in this category, but is I ask them, do you have money in the deal? And if I could touch on that, let me touch a little bit about financing if we can.
Sure.
Single family, it's easier to get in with no money. If you get the right deal, there's lenders I can know if you buy it right. There's lenders that will loan you 70% of ARV, which is after repair value. And now that number is getting harder to buy in, but when you could buy a house for 50% of ARV, 20% repairs, and you could get 100% of that at closing. So you have zero money. Now you got to build your relationship. That's really hard to do with an apartment. One,
Yes.
you're talking higher dollars, and lenders want some skin in the game. Now, just so you know, I have a letter from a banker that I've called, I haven't closed with, that said he will loan 80% of the purchase price, and he does not care if the sellers carry a 20% second. So
Okay.
basically, you could get in with zero money.
Yeah.
But usually, I've done a lot of seconds, but normally the lender wants the buyer to have 10% in
Yeah.
the game.
Well, I mean, but the thing is, the thing that makes these deals work for us, and we're doing 175 unit deals, and the only thing that makes them work and makes us competitive is that we can get those Fannie Mae, Freddie Mac loans from the federal government, 30-year AMs. Now, if you're going to a local bank and you're trying to get a 15-year AM on these deals, they don't work. There's no way. And you're competing against guys like us that can get the 30-year terms, which makes cash flow. These things actually cash flow. We can offer a little more for them. So that's a bank might be willing to do that, but if they're going to put it on a 15, can you be competitive with people that can get 30?
No. Well, let me ask you this: what's your minimum size that you do your syndication with?
Probably 80 units.
Which is
It's got to be able to support a full-time manager and full-time maintenance person. That's what we look for.
That's about $2 million, right?
Yeah, give or take.
That's where I am, and I like working those size of deals. But what I've been doing the most of that I see, you was asking about single family, transition, multifamily. Most of them need to either go syndication or build up a resume before they're going to be able to go get what you're talking about. Okay. Now I do have some national mortgage companies that can go get those loans, get me 30-year AMs, but they normally have a minimum of $1 million loan. Okay.
But Ed, how do you get that resume? What do? You don't have
that's
experience.
Where you got to go. That's what I'm doing with some guys now. I'm actually got a guy I'm trying to train. I got a 5-year plan with him. He doesn't have any houses, but he's got a little cash. Buy some houses, then he's going to go into small apartments, and then I'm going to build them up to a bigger unit. Okay.
Yeah.
But right now, what I'm seeing a demand for locally is local investors or people buying under $1 million. They're going to local banks. I'm struggling to get the numbers to work, but they're putting good sized down payments. Okay. But a lot of them are looking, it comes down to criteria. You're looking for return for your investors. I've got investors right now that are like, if it doesn't cash flow, okay, I want to pay the debt down. Okay. But you see, they're not competing with you on buying an 8 unit, 20 unit, 16 unit. And so I don't see very many syndicators buying those 16 unit deals, for $500.
Yeah, that doesn't work. But it all comes down to return, though. I think a lot of people invest in properties and they don't really look at the return. Oh, I'm going to pay this down. It's basically cash flow and be great for my family and whatever. But if you put, $100 into it and you're getting a 8% return, shit, go in the stock market. It doesn't make sense. If you're overpaying, it's gotta make financial sense if you're going to take the risk and you're going to put the time and effort into one of these deals. I mean, you can go into a syndication deal and make 15, 20%, not even get your hands dirty. So you got to know why you're getting into something.
One of the things I did, and since you've gone to my class, I've changed it and it's now a longer class, but is I took a 15-year note, and I think I took $1 million property. $1 million property, and I put on 15 and 30-year note.
Okay.
Okay. At the end of 15 years, okay, the amount of money you make between what's the 3 things you get? You get appreciation, you get debt reduction, and you get cash flow. That's your main three items. Okay. And if you look at the end of 3 years, they were very close.
Did you put depreciation in that? Do you think you get 4 things?
Yeah, that's true.
Massive depreciation on a good sized property. Okay.
Correct. But let's stick with those 3. Okay.
All right.
At appreciation, I was very conservative. I took 1%. It could be more than that. Okay.
Sure.
But I looked at debt reduction and your cash flow. I looked at those three, and they were very close to the same amount through year 15. Okay, very close. Difference was if you're on a 15-year versus a 30-year, 15 versus 30. The difference was the 30-year you had a ton of cash flow, not a lot of debt reduction.
Sure.
The end of 15, you had very little cash flow, huge debt reduction.
Sure.
But then this is what changes. This is why it works on house and somebody's going to keep it for a long time. Starting year 16, you have no debt. It's paid for. Sure. But unless you're planning on doing that, if you're going to flip it or resell it, why sell yourself short on the cash flow now that you can pull out and reinvest in something else?
Absolutely.
Okay. So it's really depending on your plan. But let me mention something on financing, if you don't mind. You can be more creative on commercial.
Okay. You can be?
Yes.
Okay.
Single family, it's a little bit tougher, but commercial deals, whether you're doing a second, whether, you're doing a second afterwards, whether you're doing, you can do a master lease. Okay. Come in and lease the whole property. Those are a little bit harder to do. But you could someone will lease the whole thing.
So a master lease is you're just going to the owner of the property. You're saying, I'm going to lease this property from you. And I'm going to, basically like a wraparound mortgage or a wraparound, like a lease option where you're taking over somebody's lease, but you're leasing at a higher rate and you're working off the spread.
Correct.
But you don't have to own it.
Yeah. And so let's say you talked about building a resume.
Mm-hmm.
Okay. So if you could go to somebody and you say you're going to put up a little money. Now, when you do the master lease, you're going to want to also get a contract. You don't want to increase the value of the property, then you have to negotiate at a higher price. So I'm going to master lease this from you on a 12-month, 18 months, so I can build a track record. And at the end, I want to buy this property from you from X.
Yeah, otherwise you're building something for somebody else, right?
Yeah, exactly. And so that gives you, if they trust you, if you have some experience, you can go in and do that. And there are owners I run into, like, we want to get rid of the headache, maybe they can't get quite the money. Now, you're going to pay more for it. Why would somebody be more creative on a deal if they could get cash, unless they just really don't want the money? Normally, they're getting a higher price.
Gotcha.
So financing, you're not getting the cheapest price. Okay? Yeah. So that's one thing. If I can, there's a couple other things. Can I jump to a couple other issues here that are totally?
Yeah, but I want to make one point on how you build your resume and how you get into multifamily when it's so difficult, because it's hard to get into multifamily. Number one, takes a little bit of capital, takes a lot of know-how. And if you want to get the good 30-year debt with Fannie Mae, Freddie Mac, you got to have experience. They want to see you've taken down a deal. So self-promoting here, but find a guy like me or my partnership. If you find the deal and you want to be a general partner, but you found the deal, we'll underwrite it. If we like it, it could be 100 units. It could be 300 units. It could be $2 million. It can be 20 million. We can raise the capital. We can take the deal down because we've got the experience. The broker will know we're serious. So I always tell people, you're looking for a 10, 15, 20 unit. That's fine. You'll get one. But if you find a 200 unit, don't pass it up. Bring it to us. Let's just look at it. We'll bring you in the deal. I mean, there's two things you can do on one of these deals that really brings value to a partnership. You can find the deal. That's huge because deals are hard to find. Or you can raise capital for the deal. You can find people that'll put the money up and become private investors for the equity part of it. One of those two things is super important. Now, if you're the person that you can't raise capital, go find deals. You find a 200 unit and you want a piece of that action, bring it to a group like us. We'll make you a general partnership. You'll be equal with us and we'll all take the deal down together. So little plug.
Well, let me just, if I can plug a little bit, if I had someone that's calling you and they're finding deals for you, okay, if they say, hey, I'm doing this deal and I work with whatever name, I've got partners that have done deals that I'm talking to and finding deals for, that carries more weight to me to like, oh, he's working with somebody that's closing deals versus I've not talked to any partners. I'm going to hopefully put out an email list to all these owners to see if they'd partner in a deal.
Well, exactly. So if somebody called you and said, hey, I'm part of a group that owns, 800 units in 4 states, you are, if you partner with us, that's what you are. You get to leverage our knowledge and we've closed, several deals with Fannie Mae loans and we've got, the experience to bring these things to fruition. You can talk to our brokers we've dealt with. Yeah, I mean, then you're one of us, and you've already you've leveraged our experience for yourself, and you could take down your first deal. You know, and that's the best way. I think that's the best way to get in. You find somebody that can bring you into the business, not only show you how the business works firsthand, but partner with you and help bring capital, put the whole deal together. The first deal you do it with us. You might stay with us on the second deal. You might figure enough to be dangerous and do it on your own. But that's how you get into the business, and that's how we did it. The first deal we did, we had to bring in expertise and partners that had already been there, and gave them a small piece of the deal, and they held our hand and showed us how to do it. So anyway, that's my take on it.
Well, okay, I was going to go on to something else, but I did want to, if I can, you mentioned passive investors. I think a lot of people need to get past the idea, I don't want to partner. I know some people, I don't want to partner with anybody. Well, that might be the best thing for you is partner. You know what I'm saying? Unless you
Sure.
want to be hands
And
on
I
in it.
understand that argument too, because there's a guy like Justin Gentry. He's not going to do a partner. He's going to take
Right.
down these. He started small and keeps getting bigger and bigger and bigger, and he's not with part. He wants to do it on his own. Hey, man, that's cool.
But
I
a
think.
lot of people's got some funds out there. They've got a job, they've got family, they like to travel. They're like, hey, I've got some money. I trust you can make a return on it. Give me my reports. That's all they want.
Yeah, exactly. And I'm passive in several deals that I love that. I'm passive in some deals a deal in Arizona. I'm passive in a deal in Dallas, to where I just get checks every month. That's all I get,
Yeah.
and I don't worry about it. But I also like the general partnership side of it. The returns are better. You make more money, but it's more work. It's not passive income. It's a job. So I like them both, and both are good.
Can I mention management just a few minutes there,
Yeah,
Rodney? Okay. Well, and let's rolling from this. Let's go. I'm going to skip on my notes here because where we're going with syndication, larger deals. One of the things that's tough on single family, you can start managing. I don't know how you started, but a lot of people start managing their own one, two houses. But at some point, they're going to either have to get someone working for them or hire a management company. Okay.
yes,
I've had a management company, which I didn't mention that we had 650 units that I had here in the city, and sold it. And so uh, it's tough for a management company to make money on small properties. They make better money on larger properties, like what you have, on-site managers. Now they charge a less amount of rent of a management fee, but you pay their salaries for the on-site managers. But the point of partnering with you or with somebody like that, you can go get a better property management because you're doing a larger property. And sometimes you've got more than one properties with that management company.
yeah,
So you carry a little bit bigger clout with that management company. When I had the 650 units, I had one guy had 230, the other guy had 100, and the rest of mine had 8 to 4. And they took so much of my time because they were micromanaging versus the other ones. Just give me my report. Can you cash flow? And all that. Oh, let me mention cash flow. You mentioned how to change, your rent. You can also lower your expenses.
oh
You
yeah,
guys put money into CapEx. Sometimes you got to look at your appliances, your AC. If we spend some money on the front end, we're going to lower expensive overall because we're not repairing those every month.
yeah.
Okay.
I mean, our last property, we went in, we did all low flow toilets, low flow shower heads. We replaced all the light bulbs to low energy light bulbs, and there's an easy way to bring down. I mean, we look at both. We want to goose the numbers on income, but expenses. We look for properties that are wildly inefficiently run, and if we can fix those expenses, that's a great way to bring. It's all about bringing the net operating income up. That's all it's about. If you can do that by decreasing expenses, increasing income, both, and I think you can find properties that are undervalued that haven't gone through the value add process and haven't updated and all that and raised the rents. You can also find a lot that are run wildly inefficient. The out
Right.
of state owner in California, he's got like an office manager that is just taking advantage of him and is running the place really crappy and is not there half the time and is just letting, there's we look for mismanaged properties, and that's a big part of our strategy.
Well, you don't mention it. We're off topic, but I think this is a great conversation. You, as a GP, I think many times, and it's one of the things I teach is there's a difference of a property management manager and an asset manager. Okay, property manager is there. Hopefully, if they're doing their job, They keep it rented, keep the maintenance down, keep any riffraff going on and that kind of stuff. They're not really looking at, am I getting the most rents? Am I making this make you the most money? I'm just running your day-to-day operation. As an asset manager, I think that fits under what you do as a GP. You're looking at reports. How can I make this make more money?
Exactly.
Where are we on the rents? How can we get the expenses down? Management company, some of them try, but their goal is day-to-day operations. And so either that you need somebody like you as a GP, or if you're trying to do it yourself, you need to know how to look at that report and manage your management company.
Yeah, that's
If
what we do.
not,
We manage by numbers, and that's why multifamily is so scalable, because we look for properties that are that support a manager, 80 units or plus, where you can have at least one manager on site and one maintenance person in a property management company that manages that manager. And now all we have to do is look at numbers and make sure the plan is being implemented. And once we get things set up and going with one location, we're off to find another location, and we can do as many of those deals as possible, which means the scalability is unlimited. We have other people managing the properties. We're just overseeing the manager, and we're managing by numbers basically. And so the scalability is gigantic. Like our first deal was 100 unit, $4 million deal. Second deal was 10 million. I mean, just keeps getting bigger and bigger and bigger, and easier and easier and easier. And the bigger the deals, the easier it gets. That's what's so weird about it. The bigger deals are easier to manage than the smaller deals. And if you're going to manage a property, you might as well, if you're going to own a property, you might as well own a 250 unit, 300 unit, because it's the same amount of work as a 75 unit deal. It really is. You might need to have 2 or 3 more maintenance people, a couple more managers on site, or leasing agents, but it's the same crap. It's the same crap. And so, that's one of the really eye openers that I learned, that properties are properties, man. Whether it's 75 units or 275 units, they run about the same, and the 275 is not harder to manage, probably easier to manage than the 75 unit.
well, we've talked a lot about syndication. I know we're going to talk about single family versus multifamily. I'm able
Let's
to
do
talk
it.
about things that maybe not hit syndication. Okay, I know we're watching our time, but one thing I want to mention is your resident profile. Okay, you sometimes, I want to think what could be a negative and make it a positive. Okay,
Okay.
people move into your house. One, you're probably not going to have turnover. You don't want turnover because it's more of a make ready, and because you're probably not going to get that much more rent if they move out. Okay, because they move out, got a lot more stuff. But if they're in an apartment, okay, that's why when I do a contract on a new contract, I said we don't want any more leases that are over 6 months until we get a new owner in, because we maybe want to change the profile. And if somebody moves out on an apartment complex and I can get $20 more a month the next tenant, and then next in 3 months I can get the next one $30, I'm changing my numbers. So you have a little more turnover sometimes in apartments. I was at a house yesterday. The lady had lived there 20 years. She paid for that owner's house maybe 1.5 times to pay for it because she's been renting 20 years. So you have a little more tenant profile. But here's the thing. Let's look at leasing. If you have 7, 10 houses, if you're doing it yourself or a leasing company in the metro, they're driving all over town to try to lease these. Okay. The second thing is they're normally not exactly the same. It may be a 3 or 2, but totally lays out different area. So it's hard to spin a tenant from one house to the other if they're not right there.
Mm-hmm.
And plus you're driving all over town. As a management company, you're charging a leasing fee, but how many times do you want to drive all over town, that leasing agent getting $100, and they got to drive over there 5 times to rent it? So what do they lean to do? And I don't know if I talked about this in the class you were in, but I had a house over here off of Penn and Hefter, okay? And I thought it rent about $1,000 a month. Nice little house, brick, 4-bedroom. And I suggested a management company, and I called to see how it went. And they said, well, they said they could only get $850 a month for it. I'm like, what, really? Come to find out, they called another management company and got them $1,050. Why would it be different? Because the other company was way on the other side of town. How many times you got to drive out there? So they would rather rent cheap and get it done. That $200 a month's a big number. Okay. Sure. Well, let's look if you have an apartment complex. You got somebody moving out, you got a vacant, but you got a couple of more 1-bedrooms coming up. You could show that one bedroom and pre-lease those other two because they're exactly the same. And
Yep.
you got one person, one place. So that just, it becomes a little bit easier on renting them. Your rental rates. It's easier to do a market survey and know, like you guys do, this is what the rent should be in that neighborhood on an apartment because you can do surveys. Houses, it's a little bit different because everything's a little unique. Okay, and so it's easier to know. It's easier to know that kind of information that you need. I know when somebody told me full rental rates, I can get that pretty quick on apartment.
Yeah.
Houses, it's a little bit different.
You know what
So
shocked me is that when we do due diligence on a apartment building, like we're going to buy one, we'll go to in that town. We've flown into Indianapolis, Indiana. We've gone to Huntsville, Alabama, and we'll go. And if we're getting really close to really pulling trigger on a property, we'll go to all the properties around it, and we'll walk into the office and we'll go, "Hey, we're with a group buying this property, and we just want to do a real. We just want to, I forgot what we call it. Excuse my language, a real analysis or whatever. But we're like, what's your vacancy rate? What's your economic vacancy? Can you show us a couple of your upgraded units? Can you show us your classic units? Yeah, sure. No, but they're really happy to do it. It's not like it's a secret. They're open books, and we're kind of all working together. And that's one thing that really shocked me. I didn't know they'd be so. First time I walked into a couple of offices, I was like, oh, they're gonna throw me out. I'm a competitor.
let me put a little bit caveat to that. Your on-site managers are going to be easier to get that information from unless they've really been hard-nosed trained by the management company or the owner.
Mm-hmm.
They're not thinking that mindset. I think if you call the management company,
Oh,
they
well, if we took that approach, we'd be
in
like,
most
we're
cases.
also looking for a management company.
Oh yeah,
You're
no,
right
that's a
down the
different
street.
story.
We might want to be using you. Show us what you're doing here. And if we can do that, because usually before we buy a property, we have a management company engaged, and we run everything through them. Like, hey, we notice and a lot of times they'll have one down the street. You've got a property just like ours. Tell us if our plan is correct. Tell us if we can get that extra $40 bump in rent if we put the granite countertop in, and if we put the gray vinyl on the floor like you did. And they'll look at everything and they'll say, yeah, we did it. We think you can get an extra $15, so not 40, 55. Yeah, and then they've got a vested interest, because if they give us those numbers and we hire them and they come on board and they can't get those numbers, they look bad. So
You just mentioned something. Whether you're buying on your own in an apartment complex or a rent house, or you're syndicating, you can have a plan what you think you can do, but if you don't have a team that not just says they can, but believes they can and will live up to it, it's not going to happen. They
sure.
have to buy into it. Okay. And I've seen that happen many times. The manager, oh, we could do that. And next thing I'm like, man, you're not doing nothing. They didn't do that. And so that's really
And some will do that, but once we find a good management company, we stick with them. And so there's a relationship there. They know if they BS us, they're not going to get any more of our business. And they want to grow like we do. They want to grow with us. And that's another point. We were trying to buy all over the place. We just been kind of buying in Tulsa because once you find a good management company and you guys work well together, it makes sense to try to develop that and grow in that area. It makes it so much easier to grow. Now, if you're owning assets all over the country or in multiple states, multiple cities, you're starting from zero with management. You got to find new management company. You got to fill them out and see if they work. But once you find a good company, you can kind of focus on that area and grow that area because you've got a great partner there. You trust each other. You know that they can vet a deal and look at your numbers, and they can tell you if you can achieve that or if you can't achieve that. And that's extremely valuable. Once you find a good property management company, try to grow that area because you've got 90% of the infrastructure you need in that area. Does that make sense?
Yeah, it's not just, I totally agree with you, but here's the other thing. You carry a bigger stick. The more you grow with them, the more you move up their priority list.
Well, that too,
So
yeah.
if you need something, yeah, if you've got a 40 unit or a 75 unit, I'm not saying they won't take care of you, but if you've got 470 units or 350 units, they don't want to lose that business. They want to make sure you're happy.
Sure.
And so you're going to, they're going to, and I hate saying that, but I'll get investors I work with buy a lot of properties versus, I just met you guys and you want to buy a house. or buy an apartment. The guys that does business with me for 20 years, it's all about relationships. That's like some of my investors I've worked with 20 years, 15 years.
Yeah.
And that's one of the things I do like. I like to see, I like, I was part of that. And I think that's with you, Rodney. Like you mentioned, you may not be in their deals forever, but if you can help them get started now, 5 years from now, they may be doing just their own deals. Uh,
Exactly.
but but if you're passive, you might not want to. You maybe say, you know what? Like we were just talking about one of our mutual friends. He's been doing this for many years, and now he's like, I'm semi-retired. He's got the money coming in, and he's living the life. So that you maybe, if Rodney's making you enough money, you maybe don't want to ever become an active. You maybe love being passive.
Well, as I get older, I try to get more passive. I try to do things that don't require a lot of my time and effort. So I think it's a natural progression as you get older, especially if you're in real estate. It just makes sense. I used to wholesale, ran my ass off, did that for a while. Then I did some flips and all that, and it's a lot of work. That's a job, man. I mean, and but it taught me a lot. And for that time in my life, that was the perfect thing to do. But as you go, you really should be trying to get more passive and more passive until you're Robert Elder and you're hanging out in Maui, for weeks and months at a time, coming back to
But
check on your business. I mean, that's passive.
yeah,
So, and
uh,
hey, you need to tell Robert I need him on the show. We need to get him on. And
okay,
I want Maui as the backdrop when I do a Zoom call with him.
all right. I'll tell him that. Um, I think, I have one thing before we close, and you tell me when you want me to do that.
No, go ahead.
So, well, I think as we wind this down, we've talked a lot about syndication. We talked about single family. We talked about getting started in multifamily. My suggestion is get out and do something. The market is great. It's not how it was. Don't be. I used to use the word you have a local paradigm. The market isn't like it was in 2000. The market wasn't like it is in 2010, 2000. It's not even like it was in 2015. Okay, it's changing, but there's still money to be made. But every deal might not fit your criteria. Okay,
Sure.
and so you got to look to make sure the deal works. But do get involved somehow. And here's the thing: you can get started with single families, buy one, buy three a year, and build your portfolio. And there's nothing wrong with that. You can say, Ed, I want to buy a $500,000 deal, and I got 100,000 and buy that. Or you can say, I've got some money and I want to invest in Rodney, and we'll get into a $5 million deal or a $2 million deal. But here's the thing: you buy one house, and you start your real estate investing, and you're building a business. You do one either with me, do $1 million apartment deal, or half a million, or you do a $2 or $3 million business deal with Rodney. You're in the business. You're not starting it. You're in the multifamily business. And so it's also how fast you want to scale to get up. That's what you talked about, Rodney. If you want to do one single family at a house, you can do it. It takes a lot longer,
Sure.
but there's people probably invest money with you and make great returns on their investment.
Sure.
And it's depending on what your goal is. I've
Well,
got one guy that I know.
Didn't
Huh?
I talk to a lot of doctors, because I'm in the medical business, and they're like, "Hey, I want a real estate. I want to get in real estate. I
Yeah.
want to buy single family homes, and I'm going to be a landlord." I'm like, dude, you make 800 grand a year, and you work 70 hours a week. How the hell are you going to like buy enough houses to? It just doesn't make sense for you. They're like, well, I don't know, understand how to get into real estate. Then I'm like, you need to look at
Well,
syndication, and you need to look at general partnerships on bigger deals. That's what you need to do.
well, let me throw this out on syndication. Though we're going long, but just an example,
No,
I have
you're
one
fine.
doctor, he's got about 200,000, and I know his goal is to retire in 5 years with 20,000 a month. I cannot go buy him one apartment complex now for 200,000 down and him retire in 3 to 5 years for 20,000 a month. But he could probably take that 200 and invest in an apartment deal, flip it. If he doesn't want to worry about it, he give that money to you. You could take that and you could help him maximize that money to in 5 years. He maybe could buy something else by then. That
Sure.
200, maybe 400,
Sure.
500, and now he can buy something that's going to give him the returns he's looking for. So
Yeah, we're
I
seeing
just tell that.
on average, it used to be like uh, I can't remember when I've got into real estate, passes were looking for 20, 25, 30%, freaking annualized return on their passive investments. And now it's it's got really competitive now. Now they're pretty happy with 15% annualized return is pretty good for a passive. Um, and so, yeah, I mean, that's kind of what you're looking at as a passive, but it's pretty damn good returns. And if you can keep your money churning like that, and plus you get really good, like when we do these deals, we do accelerated depreciation. We speed up the depreciation on these large assets and we pass it off to all of our investors. So they don't just get the cash flow and the appreciation of the property. They also get some of the depreciation they get to take advantage of. Um, but yeah, 200,000 these days. I don't know, man. You're not going to retire 20,000 a month on 200 grand doing much of anything unless you get Bitcoin and it just take off or something.
Yeah. Well, I said this earlier, local paradigms. People, whether you're buying a large multifamily, small one, or a house, don't get hung up on what the deals used to be.
Well, yeah, because someday
You
they're
got to
going
look at what it's doing today. What's the market
someday they're going to
today?
look back at 2020 and go, geez, you guys had it so good. That's just the way real estate works.
Well, you mentioned Robert. I sold several houses for him the last 5 years, and we were talking the other day, and I showed him. I said, I sold that duplex. He goes, yeah, don't mention what I sold because now I wish back and I'd have kept them, and because they were worth a lot more money. So,
Yep.
but anyway, that's probably all I've got, Rodney, unless you got something else.
Yeah, Ed, you know what? We had a list of things we're going to go over and we didn't cover a lot of it, but I'm going to have you back on and we're going to go deeper dive into this stuff. This is a good conversation, but I think we can, maybe we can even do kind of a shorter version of your multifamily introduction class. And so let's talk a little, just really quick about kind of your classes and your coaching and all that. How do people get a hold of you? What do you do for folks coming into the real estate business that want to learn multifamily, single family, and all that? Tell people how you can help them out, and then give them your contact information.
All right. Well, I do webinars, and I teach on like I do it more expanded on what we've talked about, single family versus multifamily. Now, let me say I do webinars. Before March, I did in-person classes, but starting in March of this year with COVID, I've been doing them all on webinars. So I do single family versus multifamily. Then I do a first level multifamily class, and I do it 4 hours. It's either spread 2 nights, 2 hours each, or a Saturday. Same thing for single family, getting started in single family investing. And then from there, I move into more I'm getting ready to kick off. It's going to be a bi-weekly training, be a program you can be purchased. And I do one-on-one coaching. I limit how much one-on-one coaching because it takes a lot of time and got to really, I try to come up with a plan that works for them. It's not just a cookie cutter. It's like what you're looking for and how do we get you there. And so, but the way you can reach out to me on that is just Ed at FCREZ.com. That's Ed, and FCR stands for First Commercial Real Estate. EZ stands for EdZinnamon.com. So FCREZ.com. And we can communicate. I'll get you set up with my wife, Lisa. She does all my booking. And I'm looking at scheduling some upcoming webinars for some of these classes. Some of these I do offer for free, and then that opens up the door. I really, before you spend a lot of money, at this point, I'd like to have the basic, and then like that one single family versus multifamily, I do that for free. And so you understand I don't want to spend money for a single family training that doesn't work for me. Or you understand multifamily, that's not what I want to do either. Sure. And I can get you pointed in the right direction.
Good deal. Man, I really enjoyed it. We will have you back on, and we'll really go into some more detail on this stuff. And maybe we have you on right before you have one of your multifamily online classes or something, help you promote that. But your class is awesome. It really lit a fire. It's been a couple of years, but I've taken a lot of action since then. And it just takes that one little spark, man. That one little spark can really change your trajectory in life and take you in a whole different direction. That's kind of what your class did for me. I do appreciate it.
Yeah, and it does that. Are you? I'll put you on the spot. Are you going to have a table at our meeting?
I think I paid for a table. When is it?
Okay. Well, it's December. I should know this. I think it's December the 3rd. It's the first Thursday night of December. We're doing a meet and mingle, jingle meet and mingle now. But anyway, so we're going to have vendor tables all around the room. It's going to be at the Will Rogers Event Center over there off of 44 and 36. Okay. And then we're going to have some meetings. It's our Christmas party. If you've never been to our Christmas party, we're going to be having raffles. Come in, you get tickets for free, and we're going to have items all around the room. Put your tickets in.
Sweet.
But I think maybe you're going to be there and be talking about both your private money and syndication.
Yeah, that depends on my wife. She's, this COVID thing's got her pretty freaked out. So
Yeah. Well, we were having this conversation yesterday. They put some new guidelines in that's up on Sunday before a meeting. So we're waiting to see how we maybe
it might
have to
cancel your meeting. You never
Yeah.
know, your Christmas party.
But,
So
yeah. Anyway, thank you, sir.
yeah, thank you. If you need to borrow money, Hard Money Partner. We're your hard money lenders here in OKC and Tulsa. And yeah, appreciate it, Ed. And it was a great talking to you. Rodney Miller, Hard Money Partner. Thanks a lot.